Welcome to the Ultimate Beginner's Guide to Scalping. In this course, you are going to learn the hidden dangers and pitfalls of retail scalping from a multidisciplinary perspective. This is the minimum knowledge you should have before attempting any type of retail scalping. By using important concepts found in finance, mathematics, statistics, behavioral economics, and neuroscience, you'll be able to grasp the true reality of retail trading and its many unexpected consequences. Before we proceed, you should understand that this video is made for educational purposes only. Before we start the course, we should establish the context that motivates the course in the first place. What motivated me to create this course is what I call the trinomial problem of modern retail trading, which is the combination of low entry barriers to the financial markets, high leverage, and poor financial education. Low entry barriers mean that nowadays, any person can easily open a trading account with a very small amount of money. That was not the case a couple of decades ago. Retail trading used to be a privilege of people who were financially stable enough to dedicate thousands of dollars to start trading without affecting their personal finances. The suspension of the entry barriers flooded the financial markets with hundreds of thousands of new small retail traders. By itself, the low entry barrier paradigm is not necessarily a problem. The problem begins when the next two elements of the trinomial enter the scene. Beyond the possibility of easily opening a trading account with a very small amount of money, many advantages are now accessible to the retail trader. The one that stands out the most is the obscene levels of leverage that are available. High leverage creates many technical and behavioral problems in trading. We'll examine these problems throughout the course in great detail. On top of that, the level of financial education nowadays is a bit misleading. There is a great deal of available information, which represents an increase in quantity, but there is a lot of incorrect information floating around, which represents a decline in quality. Not having enough correct information about something is already bad, but having incorrect information about something creates the illusion of knowledge, which is arguably worse. The combination of these three elements created a massive problem. There are thousands of unadvised and badly educated retail traders with unrealistic expectations and access to high leverage, flooding the financial markets on a daily basis. It's no wonder why most traders fail. The financial market is counterintuitive in many ways, and it requires serious education. Before we move on to the specific knowledge about scalping and its technical peculiarities, we need to clarify some of the consequences of the trinomial problem of modern retail trading. The fact that now retail traders can start trading with a very small amount of money, and they can theoretically produce astronomical returns with high leverage, created two situations. The first situation is that some retail traders believe they can transform scalping into a job. The second is that some retail traders believe they can become rich quickly and systematically while starting with almost nothing by using a high leverage scalping strategy. Let's begin first by attacking the notion of whether or not it's possible to retail trade or scalp for a living. First, we must make a distinction. Retail trading is done by individuals trading their own money at home. Retail traders rely only on the return they generate over their own capital. Institutional trading is done by individuals hired by institutions like funds or banks. Institutional traders receive a salary to trade for an institution. This distinction will become important in a moment. The idea that retail trading is work is incorrect, and it comes from a misunderstanding about the concept of work and the different ways of making money. Traders who believe that retail trading is work believe that work is the effort you make in order to make money. Even though this definition seems to be valid, it's incorrect, or at least it's incomplete. Working and making money are two different things, and the key to understand lies in the true concept of work and in the knowledge about the different ways of making money. There are basically two ways of making money. You can make money through earned income, and you can also make money through capital gain. These are two vastly different things. Earned income comes from work. Here we need to clarify the concept of work. Work is not the effort you make in order to generate money. Work is the effort you make in order to create value to someone else in exchange for money. Notice that the income you earn from working is not just a function of how much effort you make. It's a function of how much value you are able to generate to someone else. When we talk about earning an income, you'll get rewarded proportionally to how much value you generate to someone else. In other words, earned income is a function of how much value you produce. The higher the value, the higher the income. Value is a function of effort, which is how much you work, and competence, which is how well you work. In other words, value is generated when the quantitative aspect of effort is aligned with the qualitative aspect of competence. Another way of looking at this is that competence maximizes the amount of value you generate per unit of effort you apply. The bottom line here is that earning an income is about generating value. It's not just about generating effort. There are 3 ways to earn an income. You can sell your labor power, you can sell a product, or you can sell a service. The first one requires that you work for someone, and the other 2 require that you open a business. For example, let's take a simple example of a business that sells a product. If you employ effort with competence, you will create a product that adds value to consumers, and therefore, you will get rewarded proportionally. I'm oversimplifying this, of course, but the key point is that if you want to earn an income, you will need to create value. And as we already saw, value is a function of effort and competence, not just a function of effort. If you work hard without competence, your product will not be competitive, so despite working hard, you will not get rewarded. An institutional trader, for example, is an individual who sells his labor power to the institution in exchange for a salary. He or she receives a salary because he or she will generate value to the institution somehow if effort and competence are applied. The main point I want to make here is that earning an income is a deterministic endeavor. In other words, if you employ enough effort with enough competence, you will generate value and you will get rewarded proportionally. There's little to no chance involved in the outcome. Keep this idea in mind because it's going to be important in a moment. The other way of making money, which is completely different from earning an income, is through capital gain. Capital gain happens when a profit is generated due to a change in the price of an asset. For example, if you own stocks and the price goes up, you make a profit. That's capital gain. There are several ways of gaining capital like investing, speculation, and arbitrage. For the purposes of this course, we are interested in a form of capital gain called financial speculation. Financial speculation is when a person speculates about the future price of a financial asset based on the past information about this financial asset. It should be clear to you that retail trading is financial speculation. When traders look at the price chart, they are speculating about the future direction of price based on past information of price. Unlike earned income, which is about value, financial speculation is about information. In other words, successful financial speculation is a function of having good information about the market in question. It has nothing to do with creating value for someone else in exchange for money. The problem with that is that the future of price is uncertain, and this uncertainty comes from the fact that we have limited information about any given market. When we look at a price chart, we are looking at the final representation of the battle between buyers and sellers in its recent past. However, we cannot perfectly understand all the intentions of buyers and sellers in the market. Any financial market is composed by many different buyers and sellers with different buying or selling potential, acting for different reasons at different times. Obviously, we can infer what buyers and sellers are doing based on this limited information we have. This is what price action analysis is all about, after all. But the point is that these inferences are imperfect because the past information of price is limited, meaning that predictions will work sometimes and fail in others, even if you always analyze the market correctly. That also means that retail trading is a game of skill and chance at the same time. A good trading strategy allows the trader to rely more on his skill rather than chance, but it's impossible to remove uncertainty from the equation due to this problem of limited information. To understand what that really means, you can think about what it would be like to speculate about the future of price if you had complete information about the intentions of buyers and sellers of the market in real time. If that was possible, you would be able to perfectly predict the future of price in the short term. In the history of science, there is a concept that helps us understand this idea of limited information. It's the concept of Laplace's demon, proposed by the French scholar and polymath Pierre Simon Laplace. Let's use Laplace's own words to see what the Laplace's demon is all about. We may regard the present state of the universe as the effect of its past and the cause of its future. An intellect, which at a certain moment would know all forces that set nature in motion, and all positions of all items of which nature is composed, if this intellect were also vast enough to submit this data to analysis, it would embrace in a single formula the movements of the greatest bodies of the universe and those of the tiniest atom. For such an intellect, nothing would be uncertain, and the future, just like the past, would be present before its eyes. In other words, Laplace's demon is a hypothetical entity that is able to know all the relations of cause and effect in the world in real time. This entity would be able to predict the future of price because it would have complete information about all the forces acting on price in real time. In fact, it would be able to predict the future of anything. Needless to say, the dream of every trader is to become Laplace's demon, but that's obviously not possible. However, since there is incomplete information about any financial market, there is uncertainty about the future. That doesn't mean that price is unpredictable. Sometimes we can make good predictions and sometimes we cannot. The financial market can be classified as a complex system, which is a system that has both elements of order and chaos simultaneously. Order and chaos are not mutually exclusive. They can coexist in a system. Uncertainty, however, is always part of the market due to this problem of incomplete information. The point I'm trying to make here is that financial speculation or retail trading is a non-deterministic endeavor due to the uncertainty of the future. That means that the trader's outcome doesn't depend only on his or her skill. It also depends on an inherent element of chance outside the trader's control. This situation makes the trader vulnerable to two different types of error. The trader can make a false positive or a false negative error in his judgments. A false positive is when the trader analyzes the market incorrectly and gets a positive outcome. That creates the illusion of skill. A false negative is when the trader analyzes the market correctly and gets a bad outcome. This creates lack of trust in good trading techniques. This is when the uncertainty of the market makes the trader believe he doesn't know what he is doing. These two errors occur in financial speculation due to the inherent and unavoidable uncertainty of the future. In summary, earning an income is deterministic because acting correctly generates the desired outcome. Capital gain is non-deterministic because acting correctly is not a guarantee of having a good outcome due to the unavoidable uncertainty of the future, which is created by the problem of limited information in the markets. Capital gain in the context of financial speculation is about having information in order to make educated predictions about the future of price of a financial asset. It has nothing to do with creating value. It's one way of making money, but it's not work. The problem, however, lies more in the nature of financial speculation, which is non-deterministic. Since there is uncertainty about the future of price due to the problem of incomplete information, financial speculation is non-deterministic. Traders depend on skill and chance simultaneously. Let's now go back to the original question, which is whether or not you can retail trade for a living. When we talk about making a living, we are talking about guaranteeing different types of needs, and these needs have a hierarchy. Here it's useful to know something called the Maslow's hierarchy of needs. At the base of the hierarchy, we have the physiological needs, things like food, water, and sleep, which are critical to survival. Next, we have the safety needs, which are also crucial for survival. These two levels compose what is called basic needs. Basic needs are critical for survival, so in order to take care of these types of needs, you need to rely on something deterministic like earned income. The reason for that is that you cannot attach basic needs to the unavoidable uncertainty of the future. This is why using forms of capital gain to make a living is a bad idea. Moving up the hierarchy, we have the psychological needs, which involve relationships and feeling of accomplishment. Psychological needs are very important for well-being, but they are not critical for survival. For example, you're not going to die if you don't have a feeling of accomplishment in your life, but having this feeling positively affects your well-being for obvious reasons. The top of the hierarchy is composed of the self-fulfillment needs like achieving the full potential in life, being the best at what you do, or being deeply involved in creative endeavors. It's a hierarchy, so it necessarily follows that you need to take care of basic needs before you worry about self-fulfillment. The point I want to make here is that in order to guarantee matters of survival, you need to rely on something deterministic, meaning something where the outcome is not partly attached to the unavoidable element of chance. In other words, to make a living, you need to rely on something under your control, so you can either sell your labor force, sell a product, or sell a service. The variables involved in earning an income, like effort and competence, are under your control. They are not attached to an element of chance. Financial speculation is non-deterministic, so it should only be done if basic needs are already taken care of. Capital gain dwells in higher levels of the hierarchy. The ideal scenario is facing retail trading as a hobby or as the high-risk part of a broader, long-term investment strategy, but facing it as work is a terrible idea. If you want to trade for a living, your only choice is to become an institutional trader. An institutional trader is hired by a bank or a fund. In that context, the trader is providing value to someone else in exchange for an income. The institutional trader sells his or her labor force to the institution. He or she is not trading his or her own money. In other words, in the case of institutional trading, we are talking about earned income. When we talk about retail trading, we are talking about financial speculation. The conclusion here is that retail trading is not work, and if you start to treat it as such, you are going to be disappointed eventually because of the non-deterministic nature of financial speculation. So don't quit your job or don't drop out of college because you want to become a retail trader. That's a terrible idea. You must view retail trading as a hobby or a parallel activity to your main source of income, unless you want to be an institutional trader. That's a different story. If you view retail trading like a hobby or simply like something you like to do, it can be a healthy thing. If you depend on retail trading to pay your bills, you will enter a bad road that is likely to destroy your financial life. You might be wondering why institutions can rely on trading for survival if trading is non-deterministic. The key here is to understand that the money that institutions make doesn't come solely from the returns they produce over their clients' capital. Let's take the example of a fund. The goal of a fund is to generate alpha over a benchmark. That means that the goal is to generate a better return than a market index. For example, the goal of a fund can be to generate a better return than the S&P 500. Otherwise, the clients of this fund have no motivation to allocate their money in the fund. They can simply buy the S&P 500 instead. The fund makes money in two main ways. They charge administration fee, which is fixed, and a performance fee, which is variable. The administration fee is charged regardless of the fund's performance, so it's a deterministic source of income for the fund. The performance fee is charged when the fund can in fact generate alpha over the benchmark, so it's a non-deterministic source of income for the fund. Unlike retail traders, institutions can make money even with bad returns because of the administration fee. Retail traders cannot charge administration fees because they trade their own money, so they lack the deterministic source of income that institutions have. The bottom line is that retail trading is not a job, and if you want to trade for a living, you need to be hired by an institution. Let's now move on to the question of whether or not you can become rich quickly with scalping. We just tackled whether or not you should attempt to retail trade for a living. Hopefully, you were able to see why retail trading is not a job and how trying to transform it into a job will create problems. Now we need to attack a different problem, which is the idea that scalpers want to become rich quickly while starting with almost no capital. We'll use some of the concepts outlined in the last section and introduce new ones as well. When we talk about trying to get rich quickly, it's useful to analyze the situation mathematically using the compound return formula, which goes as follows. A is the final amount, P is the principal or the amount you start with, R is the return, and T is time. In other words, the final result is a function of three variables: how much you start with, how much return you get periodically, and for how many periods you do it. For example, if you start with $1,000 and you get a monthly return of 2% for 60 months or 5 years, the final result will be $3,281.03. Let's take a moment to analyze the three variables that affect the final amount and perceive unique properties about them. The first thing to notice is that all three variables positively affect the final amount, meaning that an increase in each of these variables will cause the final amount to increase also. The principal P is the amount you start with. The larger the principal, the higher the final amount with all else maintained equal. For example, if we use the same parameters from the previous example where P equals 1000, R equals 2%, and time equals 60, we get an A equal to 3281.03. If we maintain the same parameters and change P to 3000, we get an A equal to 9843.09. The principal usually comes from outside trading. Most people will devote a part of their earned income to start trading. That means you can control the principal by enhancing your earned income outside of trading. In other words, the better your earned income is, the better your final amount will be. The main point here is that you can enhance your principal by enhancing the earned income, which comes from work outside of trading. Next in line, we have the return variable. Return is how much capital a person is able to gain in percentage terms over a given period. Return also positively affects the final amount. If we change the return from 2% to 4% with all else maintained equal, we go from a final amount of 3281.03 to 10,519.63. The return is a powerful variable in the formula, but it's also the most difficult to control. This relates to what we talked about earlier. The future of price is uncertain because there is limited information about all the variables acting on price. So predictions about the future of price depend both on skill and on the unavoidable element of chance. Beyond the return being a difficult variable to control, it can also go against you, unlike the principal and time. You can have a negative return, but you cannot have negative principal, and time only goes forward. Time is for how many periods the returns are compounded on the principal. If we compound $1,000 at 2% monthly return for 120 months instead of 60 months, we get 10,765.16 instead of 3,281.03. Time is a variable that is always on your favor. Despite not being able to control how time passes by, the longer you compound returns on the principal, the better the result's going to be. Notice that out of the three variables, the return is the tricky one. Principal you can control by enhancing your earned income outside of trading, and time only moves on your favor. The return is the variable that is difficult to control and the one that can go against you. If you try to get rich quickly while starting with almost nothing, you are reducing P and T to a minimum and trying to compensate that with R. The problem here is that R is too difficult to control because it's non-deterministic, and it can also go against you. Notice also that time is being used as an exponent in the compound return formula, so it's a powerful variable that only goes on your favor. Trying to neglect the time variable is only going to make your life more difficult. Beyond that, in order to compensate the minimization of P and T by altering R, you need to get astronomical returns, and this is where the villain called leverage enters the scene. Leverage is like putting returns on steroids. There are many side effects to high leverage. In this section, we'll analyze the most dangerous aspects of leverage. The first thing about leverage is that it increases risk. Here we have to define what risk means. In finance, risk is the standard deviation of returns. This is the formula for standard deviation, but we have a more intuitive way of understanding what it means. Standard deviation is how much something deviates from its mean. Imagine that we plot a trader's percentage returns on a histogram. If this trader uses small risk, the returns will not deviate too much from the mean of returns. However, if the trader increases the risk, the returns will start to deviate more from the mean of returns. Another important notion here is of the upside and downside risk. Upside risk is the standard deviation of positive returns. Downside risk is the standard deviation of negative returns. Another way of seeing that is by observing how low and high standard deviation of returns would look like in an equity curve plot. The green curve represents a strategy with low standard deviation, meaning low risk. The returns are small, so each individual return doesn't deviate too much from the mean of returns. In the red curve, we have an example of a high standard deviation or high risk. The equity curve oscillates more violently, meaning that each return deviates more from the mean of returns. Here comes the first problem of high risk caused by high leverage. When leverage is too high, your account will not have enough capital to sustain downside risk. Once again, we can easily understand that geometrically. Upside risk is never a problem. The greater the positive return you get, the better for your equity. However, if downside risk is too great, your account will break over and over again. Traders will often focus only on how much they can win in a certain amount of time, but ignoring the other side of the equation is obviously a mistake. Please understand that you can never know how much you're going to win, but you have the obligation of knowing how much you can lose. Another problem of high leverage is associated with something not so obvious, which is the S-shaped value function. This is something part of the prospect theory, which made Daniel Kahneman win a Nobel Prize in economics. The value function measures how we perceive wins and losses. Imagine that we can attribute a value to a win and a loss of the same magnitude. For example, let's imagine that we measure how a $100 win feels and how a $100 loss feels. Kahneman suggests that we perceive proportional wins and losses asymmetrically, meaning that an X amount of dollars loss feels worse than an X amount of dollars win feels good. In other words, losses affect us psychologically more than wins, even when we are talking about the same amount. High leverage supercharges both positive and negative returns, so it's easy to see that high leverage can create too much psychological distress when negative returns occur. The implications of this are enormous. Depending on the degree of leverage being used and the size of the negative return, even hardwired defense mechanisms of the brain can be triggered, as we'll see later in the course. Leverage also creates the illusion of skill because traders will measure performance by the P&L resulting from leveraged returns. One idea that is absolutely necessary to have in mind is the difference between the leveraged and unleveraged return. For example, if you buy a stock at $40 and the stock goes up to $42, you made a 5% unleveraged return. It's unleveraged because we are measuring the percentage change in price, not the percentage change in P&L. However, let's say that you use 1 to 5 of leverage in this particular trade. Your gain will be multiplied by 5, so a 5% change in price causes a 25% change in P&L. This is the leverage return reflected on the P&L. In summary, the unleveraged return is the percentage in price that the trader is able to gain or lose in his or her trades. It's a good measure of performance because it shows how much the trader can predict the market without distortions. The leveraged return is the percentage change in P&L that the trader is able to gain or lose with leverage. This is a poor measure of performance because you can have a positive P&L while having negative unleveraged returns. This will create the illusion of skill. Skill here is associated with how much percentage change in price a trader is able to get, not how much change in P&L. Let's observe a quick example of that. On the left column, we have hypothetical unleveraged returns, meaning the percentage change in price that a trader is able to generate with his or her trades. On the middle column, we have the amount of leverage used in each trade. On the right column, we have the leverage return. Notice that the trader is varying the degree of leverage according to his or her own discretion. The point here is that if we compound the unleveraged returns, we will get a negative return of minus 4.09%. If we compound the leveraged returns, we'll get a return of 5.34%. This trader will have the illusion of skill because he will measure his performance using the P&L, which reflects the leveraged returns, but in reality, the true performance, which should be measured based on unleveraged returns, is actually negative. You might be thinking that being able to get a positive P&L with negative unleveraged returns is a good thing, but it's really not, and here comes the pernicious detail about this. The trader might be able to get away with this in the very short term, but in the mid and long terms, things change because of something called the law of large numbers in statistics. The law of large numbers states that the larger the sample, the more the experimental probability will converge to the theoretical probability. Translating that into a simple experiment first, let's think about a coin toss. We know that the theoretical probability of heads or tails in a coin toss is 50%, because there are only two possible outcomes and they are equally likely to occur. Let's imagine that we toss a coin 3 times in a row. This is our sample. To measure the experimental probability of getting heads, for example, we must take the number of times that the coin toss resulted in heads and divide that by the sample size. In this case, the experimental probability of heads is 33.34%. Notice that this differs a lot from the theoretical probability of 50%. The law of large numbers states that the larger the sample, the closer these two numbers will get. Let's see an example. In this situation, we have 12 coin tosses, where 5 of them result in heads, yielding an experimental probability of 41.67%. If the sample was much larger, you'll see that the theoretical and experimental probability would be very close to one another. What all of this means is that iteration makes the two probabilities converge. Translating that into the trading paradigm, we can say that the reality of the trader's performance only emerges in the mid and long terms. In other words, the trader might get away with a positive P&L while having negative unleveraged returns because of the effect of leverage, but this effect is doomed to fail as the sample of trades grows. An additional point of complexity here is how the trader uses leverage. Some scalpers might argue that using leverage is a skill, but the reality is that their use of leverage comes mostly from their emotional state. Abuse of leverage will usually come from greed or desperation to save an account about to break. Since trading is a game of skill and chance simultaneously, eventually the scalper will over-leverage the wrong trade, which will cause a large loss that will trigger a host of different behavioral and neurological patterns. Traders must understand that high leverage trading always leads to a slippery slope, so the trader will not stop doing it until he reaches a point of no return, so to speak. We'll study these behavioral and neurological triggers in detail later in the course. We must now move on to the technical problems of scalping. First and foremost, we must define what scalping is precisely. A lot of people believe that scalping is about trading lower time frames. Even though that is partly correct, this is not what defines scalping. The definition of scalping is the pursuit of small and immediate rewards, but small and immediate are relative. Small in comparison to what? Immediate in comparison to what exactly? Because of this issue, we must think about scalping not only as the pursuit of small and immediate rewards, but small rewards in comparison to the risk associated with them, and immediate in comparison to how much time the trader is willing to wait in order to realize a profit. That immediately translates into a certain type of risk management structure where take-profit targets are small and stop-loss orders are large. Scalping usually occurs in lower time frames because traders want as much action as possible, but since the idea of small and immediate rewards are relative, you can theoretically scalp higher time frames also if you maintain this risk management structure. This is partly why scalping is not necessarily the same as trading lower time frames. Another important notion is that you can use lower time frames for trading styles other than scalping. The correct mode of day trading, for example, happens in lower time frames, and yet the risk management structure is completely different than the one we find in scalping. In summary, scalping is not just about trading lower time frames. It's about a certain risk management structure that inevitably arises from pursuing small and immediate rewards. It just happens to be that scalping is mostly done in lower time frames, since scalpers want as much action as possible. Here it's useful to think about trading approaches in terms of where they sit in the risk-reward spectrum. Imagine that on one side of the spectrum we have small take-profit targets and large stop-loss orders, and on the other side of the spectrum we have large take-profit targets and small stop-loss orders. The risk-reward spectrum is all about the relationship between the entry, the target, and the stop. The implications of different regions of the spectrum are vastly different. Here we can also introduce the very important idea of immediate and delayed gratification, which, as you'll see later, has dramatic effects in terms of behavior and for long-term sustainability of the equity curve. Small and immediate rewards with large risk are about immediate gratification, meaning that the trader wants small and immediate rewards. This is what scalping is all about. Large and later rewards and small risk are about delayed gratification. This is where responsible trading fits in. The point here is that immediate and delayed gratification produce vastly different scenarios for the trader. For example, immediate gratification tricks the brain into addiction, while delayed gratification creates a sustainable environment for the trader, not only technically, but also psychologically. That's not just the case with trading. There are many situations in life where immediate gratification will lead you down a bad path, and delayed gratification will lead to a good path. We'll return to this idea later on. Let's talk about the other technical problems of scalping. The first one is called market friction. Market friction is the effect of trading costs on the equity curve. No matter if you win or lose a trade, you are always paying spreads or commissions. In scalping, traders will produce too many trades, so the effect of market friction becomes augmented. When you add the fact that scalpers go after small rewards, the problem becomes even greater. The ideal scenario is the opposite of what scalpers do. You should seek to trade with less frequency while aiming for larger rewards if you want to diminish the effect of market friction. Market friction is what makes brokers make more money, by the way. The more you trade, the more the broker makes money. That does not mean that brokers are evil or anything like that. It just means that they make more money with scalpers, while scalpers hardly ever have good results in the long term. Another problem that traders face in a greater degree in scalping is the asymmetry between winning and losing trades, meaning that losing gains is easier than recuperating losses. The best way to understand this is by using an example. Let's say a trader loses 20% of his capital. In order to recuperate his loss and go back to the starting point, the trader needs a return greater than 20%. For instance, let's say a trader has $1,000 and he loses 20%. Now the trader has $800. In order to go back to 1,000, he needs to gain $200. $200 on top of $800 represents a 25% return. In other words, in order to recover from a 20% loss, the trader needs a 25% return. Now let's imagine that the trader starts with $1,000 and then he wins 20%. The account goes to $1,200. In order to lose the 20% return, the trader needs a negative return that is lower than 20%. In this case, a negative return of 16.67% is enough to wipe out a 20% gain. Given the situation, you can clearly see that losing your gains is easier than recuperating losses. In the context of scalping, since the winning trades are small and the losing trades are large, you need to create an extra run of winning trades to recuperate a large loss. In other words, it's a lot harder to fight this problem when the winning trades are small and the losing trades are large. Another way of looking at this is that scalping supercharges this problem of the asymmetry between winning and losing trades. It's easy to wipe out positive returns, while it's harder to recuperate losses. Another problem with scalping is the frequency of opportunities. Scalpers like to believe that the market is an endless source of opportunities, and no matter what time of the day you enter the market, you can find good opportunities. That's not true for a few different reasons. Since the market is a complex system, meaning that it has both elements of order and chaos simultaneously, it's clear that there are times when trading is impossible, and there are times when trading is easy. That argument alone is enough to disprove the fact that the market is an endless source of opportunities, but there's more. The market moves in what's called Brownian motion due to the fact that buyers and sellers of different kinds and different buying or selling potential act for different reasons at different times. This is the model for Brownian motion for those who are more curious, but we are not going to go into it since this is a beginner's course. That implies that good trading opportunities only really happen when there is an intersection of different buyers and sellers acting in unison to the point where a significant reversal in price occurs. That happens with good frequency, but it certainly doesn't happen all the time. The rest of the market is noise that can sometimes be explained, but not always successfully traded. In other words, instead of thinking about the market as an endless stream of opportunities, you need to think about the market like a hunter thinks about prey. You need to wait for the right moment to attack, and several sensitive factors must agree for that to happen. In fact, Trading correctly means that you're going to wait for long periods of time for the opportunities to align properly. It's not so much a matter of the trader going after the opportunity. It's more a matter of being in front of the opportunities when they appear. In other words, when trading is done correctly, it's composed of long periods of waiting and analysis punctuated by the occasional pull of the trigger. A hunter doesn't enter the wild shooting in every possible direction all the time. That would be extremely wasteful and counterproductive. It's not difficult to see why the scalping mentality is attractive. It proposes a way to avoid the boredom of trading correctly. However, the consequences of the scalping mentality are many. In summary, high-quality trade opportunities don't happen every minute. They are not as frequent as scalpers like to believe they are. This problem leads directly to another problem of scalping, which is how traders measure the quality of their trades. Scalpers usually measure their performance by the win rate, which is simply the number of trades you won divided by the total number of trades. For example, if you make 100 trades and win 70 of them, your win rate is 0.7 or 70%. The win rate is an important metric without a doubt, but by itself it paints an incomplete picture about the trader's performance. High win rates do not mean skill. When your targets are close to your entry point, they are going to be hit more frequently simply because they are closer to the entry. Even the natural market noise will make your targets get hit sometimes. If even the market noise can make your take-profit targets get hit, that tells us that hitting a small target is not just about skill. A high win rate also does not mean anything without the context provided by the risk-reward ratio. For example, you can have a 95% win rate and still break your account if the risk-reward ratio is bad, or you can have a 40% win rate and make money if the risk-reward ratio is good. Judging if the win rate is high or low depends on the minimum win rate you need to make money according to your risk-reward ratio. The risk-reward ratio is simply the ratio between the target and the stop. For example, if your stop loss is 10 and your target is 30, you have a risk-reward ratio of 3. The minimum win rate you need to make money with a given risk-reward ratio is given by the following formula: 1 divided by 1 plus the risk-reward ratio. If we use a risk-reward ratio of 3, we have a minimum win rate of 25%. That means that you only need 25% of your trades to be successful in order to break even. So it logically follows that any win rate above 25% will make you money, and therefore, any win rate above that is in fact good. In this example, we use a risk-reward ratio where the target is a few times larger than the stop. Let's observe what happens when the stop is many times larger than the target, like what happens in scalping strategies. For example, if the stop is 5 times larger than the target, the risk-reward ratio will be 0.2. The minimum win rate at that level is 83.34%. In other words, you need a much higher win rate just to break even. Because the risk-reward ratio is very poor in scalping, the trader needs a super high win rate, and even if the trader does manage to get it, it still doesn't guarantee anything because when losses occur, they devastate a large portion of the winning trades. That has psychological and neurological ramifications. It's the fact that the risk management structure of scalping generates overwhelming losses that makes scalping particularly bad. In summary, the win rate means nothing without the context provided by the risk-reward ratio. You can break your account with a 95% win rate, and you can make money with a 30% win rate, for example. The keys lie in the context given by the risk-reward ratio and the psychological and neurological effects produced by large losses. Another dramatic technical problem of scalping is the opportunity cost. In economics, the opportunity cost is everything you need to give up in order to act in a certain way. People usually think about the financial cost of doing something, but there are other implicit costs as well. For example, if you spend a lot of time watching TV, there is not a significant cost in terms of capital, but there is a significant cost in terms of time. Think about everything else productive you could be doing with that time instead. Scalping has a ridiculously high opportunity cost in terms of time. Scalpers sometimes spend several hours in front of the computer screen. Scalpers will argue that they are working, but as we already saw, financial speculation is a form of capital gain, not earn income. So if you spend too many hours trying to scalp for a living, you are wasting your time. This is also the problem with day trading, where too much time is spent in front of the computer. This is why responsible day trading is only done in small doses. In that case, swing trading might be a better idea. Before we move on to the behavioral and neuroscientific aspect of scalping, I want to talk about two very important notions in finance. These two notions will change the way you approach the pursuit of profits. The first idea relates to how you should measure the quality of a return. In the financial markets, you often see people bragging about how much they made in a given amount of time. They will say something like, I made X% return in a matter of Y number of days, for example. To understand the problem with that, let me ask you a question. Which alternative do you prefer? A 10% return with a 2% risk, or B, 20% return with a 5% risk? Most people will choose alternative B because they think the higher return is better. That's because they are looking at the return while ignoring the risk that is associated with this return. Another way of looking at this is that they are looking at the size of the return instead of its quality. The right way to view this is to look at the return's quality, meaning the alternative that yields more return per unit of risk. For example, in alternative A, you get 10% return while assuming 2% risk. Dividing the return by the risk, you get 5 units of return per unit of risk. In alternative B, you get a 20% return while assuming a 5% risk. If you divide the return by the risk, you get 4 units of return per unit of risk. In other words, even though the alternative A yields a lower return, the quality of the return is better because it yields more return per unit of risk. So when you see someone saying that they got X% return in Y amount of time, you should ask them if they know how much risk they assumed in order to get that return. Most people will not be able to answer that question. The intuition you should get from this is that the right way of measuring a return is by measuring it against the associated risk, meaning how much return per unit of risk. Here's a small lesson about leverage. Consider the following alternatives. A, 10% return with a 2% risk. B, 20% return with a 4% risk. C, 30% return with a 6% risk. And D, 40% return with 8% risk. According to what we just saw, all of these alternatives have the exact same quality because they all yield 5 units of return per unit of risk. If they are all the same in terms of quality, you might be thinking that you can pick the one that yields more return, but that's incorrect. Alternative D has a higher risk, which will translate into more psychological distress. By using leverage, you are increasing risk without changing the quality of returns while increasing psychological distress. In summary, higher returns do not mean better returns. The other notion you need to have relates to the overall goal when dealing with risk and rewards. The goal is not to have the highest return possible. As we just saw, a higher return is not necessarily better. The goal is to maximize returns while minimizing risks. There's a limit to how much you can do that, but there is certainly a lot of room for optimization. In other words, you should aim to squeeze the highest amount of return per unit of risk. That's what's going to make you safer in the market. In order to maximize your rewards while minimizing your risks, you need to be able to enter your trades near the reversal points of the market. And chances like that don't happen as often as scalpers like to believe, as we saw earlier. Let's now move on to the study of the behavioral economics of scalping. When we talk about scalping, there is a series of different emotions and biases that take place. The study of behavioral economics is quite extensive, so in this beginner's course, we will only take a brief look at the most relevant ideas. We'll talk about some cognitive biases that shape certain kinds of behaviors in scalping, like the motivation to use a scalping strategy, the illusion of skill, the illusion of control over emotions, and why scalpers keep trying the same thing again even after repeated failure. First of all, we should define what a cognitive bias is. A cognitive bias is a systematic error in thinking, a pattern of thought that deviates from rational judgment. These errors are present in all human beings, and they have their evolutionary purpose, but that's another story. For this course, you should know that cognitive biases are faulty thinking patterns that steer people's behavior away from rationality. Let's begin first by analyzing the motivation to use a scalping strategy. We can say that this motivation comes from a combination of two cognitive biases. In other words, the motivation to use a scalping strategy comes from the intersection between two errors in thinking. The first error or cognitive bias is called action bias. The action bias is the tendency people have to prefer action over inaction when trying to reach a goal, even when not acting is a better choice. In other words, we feel better acting than not acting if we're trying to achieve something, even when not acting makes more sense. In the trading context, there are a lot of times when not trading is better than trading, but because of the action bias, traders are always compelled to trade. When traders don't trade for a longer period of time, they begin to feel boredom, which is interpreted by the brain as psychological pain, and that is in part what drives them to action even when not acting is a better choice. In a good trading strategy, the trader has to constantly fight this feeling of boredom and exercise patience to wait for the right moments to trade. A scalping strategy where the trader pulls the trigger all the time creates a false solution to the boredom of undertrading. In other words, the trader will overtrade to compensate boredom, not necessarily because a good opportunity appeared in the market. The second error in judgment that adds on top of the action bias is something called hyperbolic discounting, which is the tendency to prefer immediate rewards rather than rewards that come later in the future, even if the immediate rewards are smaller. That cognitive bias perfectly mirrors the risk management structure of scalping, which is composed of small targets and large stops. Hyperbolic discounting occurs because people are mostly risk-averse, so an immediate and smaller reward seems less risky than a greater reward in the future. Even though it seems like a smaller risk, the iteration of decisions like this creates a larger risk in the end. The alignment between the action bias and hyperbolic discounting creates the behavioral basis for scalping. Next, we are going to talk about two errors of thinking that can generate the illusion of skill. The first error is called hot hand fallacy, which is the tendency to believe that a winning streak is likely to lead to further success. This tends to happen in the beginning of a scalping strategy, and it relates to what we talked about earlier regarding the law of large numbers. The hot hand fallacy makes scalpers believe that small samples of winning trades are representative of a successful long-term scalping strategy. They assume their performance will continue going like that forever. The other bias that adds to the illusion of skill is called Dunning-Kruger effect, which states that a person with lack of knowledge tends to overestimate their abilities. In other words, the less a trader knows about trading, the more confident the trader tends to be about his abilities. If we look at the geometric representation of the Dunning-Kruger effect, we'll see that confidence rapidly rises with minimal knowledge about any given topic. This is a situation where arrogant incompetence and illusion of skill can occur. As more knowledge is gained, the level of confidence drops because there is an increasing perception that things are more complicated than what the person thought them to be in the first place. If the person continues to gain knowledge, however, the level of confidence begins to rise again, but this time the confidence level matches the level of skill obtained with true knowledge. The Dunning-Kruger effect happens because those who have shallow knowledge about something also don't have the insight to see their own limitations in that area. The hot hand fallacy and the Dunning-Kruger effect feed off each other in the context of scalping. The initial winning streak of a scalping strategy creates the illusion that small samples of data are representative of large samples of data, meaning that an initial winning streak will continue happening in the long term, and also creates the illusion of skill in people with superficial knowledge about the markets. Next, we can talk about a couple of cognitive biases that cause traders to have the illusion of control over their own emotions. The first bias is called restraint bias, which is people's tendency to overestimate their control over impulses. The restraint bias occurs because of another bias called empathy gap, which describes people's inability to correctly identify how emotions impact behaviors. In other words, the fact that we don't accurately identify how emotions impact behaviors creates a certain kind of illusion of control over our own emotions in the future. For example, you overestimate how much you can tolerate hunger in the future when your stomach is full in the present. This is critical for high leverage scalping because scalpers overestimate their ability to control their emotions when extreme situations happen. For example, if a scalper sees an over-leveraged trade going against him, his emotions are likely to take over. We talk about how emotions take over from a neuroscientific point of view, but the point here is that traders overestimate how much they will be able to control their future emotional states. That will inevitably lead them to situations that they cannot control. These are just a few examples of the issues of scalping in the light of behavioral economics. This is just the tip of the iceberg, of course. The study of behavioral economics goes much further and much deeper than this, so I encourage you to study this subject on your own time if you have the interest. Now I want to talk about something that I never see anyone talking about on the internet in the context of trading, at least not with the seriousness that it deserves, which is the fact that scalping can become a form of addiction if taken to an extreme, just like gambling addiction, for example. I want to grab your attention to the mechanism that creates this problem. To understand the mechanics of addiction, we need to understand something called the pleasure trap, which is a paradigm where the modern environment fools our ancient neurochemistry, and things like addiction and health problems emerge. Before we understand the pleasure trap, we need to know another concept called the motivational triad. The motivational triad is what motivates us towards any goal in life. Biologically speaking, we are hardwired to seek pleasure, avoid pain, and conserve energy. That's the motivational triad. In other words, we move towards things that gives us pleasure, we move away from things that causes us pain, and we want to conserve as much energy as possible in the process since our energy is limited. To illustrate this, let's use an example outside of trading first. Imagine that you are hungry and you need to get some food. You have basically two choices. You can go to the grocery store, buy healthy whole foods, go back home, cook it, and then eat it. This might take a few hours to accomplish an effort on your part. The other choice is ordering fast food online. In about half an hour, the hyper-palatable meal will be at your door without much effort on your part. Beyond that, the high-calorie, high-sugar, and high-fat fast food will activate the pleasure centers of the brain much more than the healthy food will because of this higher density of things that gives us pleasure. To your brain, the fast food not only tastes better, meaning that it gives more pleasure, but it conserves energy also. It's quicker and easier to get. The problem is that fast food is a modern invention, so it's not natural. Our bodies did not evolve to deal with fast food in this way. We are only supposed to eat healthy foods found in nature because that's what our bodies evolved with. The point here is that the abnormal environmental cue created by fast food ends up fooling the brain. It makes the brain believe that it's being efficient because it's gaining more pleasure at the same time that it is conserving energy. Let's look at the situation geometrically. When we eat healthy foods that we evolved to eat, our perception of pleasure is natural and sustainable because it doesn't create chronic diseases like fast food does. You can binge on healthy foods all you want and you're not going to get sick or overweight. As soon as we start to eat fast food, our perception of pleasure skyrockets. The problem here, and this is critical for the pleasure trap, is that our brain gets used to these abnormally high levels of pleasure as a defense mechanism, meaning that it dulls down the feeling of pleasure and you end up getting used to it. In other words, now you created a new standard for your pleasure-seeking behavior. Now the pleasure you get from fast food is relatively similar to the pleasure you would get from healthy foods in the first place. However, we know that eating fast food leads to a series of health problems. So let's say you stop eating fast food and now you decided to be healthy again and only eat whole foods and etc. Your brain will not get the normal pleasure it used to get from healthy foods, and you will have the sensation of diminished pleasure, and you will desperately try to go back to the new standard of pleasure that you have created. Going back to normal is a long and tedious process because you need a period of understimulation to compensate for the period of overstimulation. You need to reset the pleasure centers of the brain, so to speak, and that takes time and understimulation. The point here is that you cannot keep eating fast food to maintain your new standard of pleasure because that will cause a series of chronic diseases over time. The trap is that while you are eating fast food, your brain believes that you are being extremely efficient because of the motivational triad, so you feel good. You are gaining pleasure, avoiding pain, and conserving energy, but all you are really doing is undermining your health. In summary, the pleasure trap makes us feel good when we go towards something bad. It makes us feel bad when we go towards something good if the environmental cues are disproportional. That's the case with any form of addiction: fast food addiction, social media addiction, drug addiction, gambling addiction, and yes, scalping addiction. Have you ever wondered why you cannot stay for too long without checking social media on your phone? Or why you cannot seem to choose a series to watch on your favorite streaming service? Or why you have a difficulty to watch a YouTube video until its very end? Or why it's so easy to eat incorrectly in our modern society? The answer is the pleasure trap. When the disproportional and unnatural environmental cues of modern life fool our ancient neurochemistry. Let me give you another example, this time in the animal kingdom, just for the sake of illustration again. Imagine a moth flying at night. The moth is an insect that evolved to fly towards light and celestial objects for navigation. It's an amazing feat of biological evolution that took who knows how many thousands of years to develop. However, when a moth encounters a porch light, which is a relatively modern invention compared to the biology of the moth, it creates a disproportional environmental cue. The moth will fly towards the porch light, thinking it's being extremely efficient. After all, it's the brightest light in the night sky. Needless to say, it will keep hitting against the porch light until it dies. In summary, a disproportional environmental cue makes the moth believe it's being efficient, but in reality, it's flying towards its death. Bringing this paradigm to the context of scalping, we have the same problem. The immediate gratification created by leverage and the peculiar risk management structure of scalping creates a disproportional environmental cue. Every winning scalp trade tells you that you are moving towards your goal efficiently. However, that's just the environment fooling your neurochemistry. If we look at scalping under the light of the motivational triad, we see that a scalper's brain perceives that more pleasure is obtained through hyper returns produced by leverage, more pain is being avoided since scalping bypasses the boredom of trading correctly, and more energy is being conserved because scalpers don't have to wait for opportunities to align properly and for trades to run their natural course. However, just like in the example of a healthy food and fast food, doing the wrong thing feels right and doing the right thing feels wrong when the environment creates disproportional environmental cues. Like any other form of addiction, the long-term implications of scalping are terrible. Scalpers are like a moth flying to the flame. They think they are being efficient, but in reality, they are flying directly towards their death, metaphorically speaking. The natural course of a trade opportunity, if you will, is the absence of leverage and letting the trade run its course with small risk and large potential rewards. Larger targets usually take longer to get hit. What I'm saying is that the correct way of trading requires a lot of patience, and it's about delayed gratification. Here we find that tension between immediate and delayed gratification once again. Immediate gratification feels good and motivating, but it leads to destruction. Delayed gratification feels boring and uncomfortable, but it leads to constructive sustainability. This is, of course, an immense paradox created by the tension between modern technology and ancient neurochemistry. The only way to avoid it is to know how it works. The ultimate mind trick to bypass the pleasure trap is to accept that building something substantial in any domain is not about seeking pleasure. It's about managing suffering. The feeling of delaying gratification is bittersweet. It's uncomfortable, but it's also motivating and pleasurable if you think about the future outcome. Immediate gratification feels motivating, engaging, and pleasurable in the short term, but it creates damage, chaos, and situations that are overwhelming in psychological and neurological terms in the long run. Delayed gratification feels boring, uncomfortable, and tedious, but it's the stuff that creates positive, consistent, and solid outcomes in the long term. The key point here is that even though delayed gratification is tedious and boring, it's not overwhelming, meaning that moderate self-control is enough to overcome it. That's not what happens with the slippery slopes created by immediate gratification. Over time, Immediate gratification will put you in situations where ancient biology will take over and irrationality will prevail. Even though scalping can become a form of addiction, it's not like drug addiction, which is far stronger and more serious. So do not use this as an excuse to continue scalping. If you are aware that you are addicted to this form of trading, take some good time off so your mind can recover and then go after learning better things about trading. Understanding the mechanics of how scalping can become addictive is usually enough to overcome it. Another thing that helps to overcome an addiction is to substitute it for something positive. Last but not least, I want to talk about a situation that happens with scalpers from a neuroscientific point of view. We saw that the immediate gratification quality of scalping leads to a bad road, even though it feels right. Part of this bad road I'm talking about is a situation where the more primitive parts of the brain take over rational thinking as a defense mechanism. This is also something that traders cannot control no matter how much willpower they think they have. One of the hidden dangers of irresponsible scalping is related to the neuroscience of risk-taking. Risk is associated with danger detection, and the human brain has several ways of dealing with danger. Depending on how you deal with risk, your brain will sabotage your behavior as a defense mechanism. Before jumping to this specific situation I'm talking about, we need to learn a few things about the human brain. We begin by talking about the triune brain model, which is a model proposed by the neuroscientist Paul MacLean, and it shows that the human brain is divided into 3 different regions that play different roles and developed in different times throughout the course of biological evolution. The oldest region of the 3 is the R complex, also known as the reptilian brain. This is the oldest of the 3, and is composed by the brainstem and cerebellum. The R complex is responsible for things like heart rate, breathing, body temperature, and balance. In other words, very basic survival mechanisms that are common among many different animals. The R complex first appeared in fish around 500 million years ago. The second region is the limbic system, which is composed by the amygdala, hippocampus, thalamus, hypothalamus, basal ganglia, and the cingulate gyrus. It's the part of the brain responsible for emotions, since it can record memories of behaviors that create agreeable and disagreeable experiences. The limbic system appeared in small mammals around 150 million years ago. The third region is the neocortex, the most recently evolved part of the brain responsible for language, abstract thought, imagination, and consciousness. The neocortex appeared in primates around 2 to 3 million years ago. These 3 regions play different roles, but they are connected to one another. For the purposes of this course, we are particularly interested in a part of the limbic system called amygdala. The amygdala is an almond-shaped structure located near the hippocampus in the frontal part of the temporal lobe. It's a critical structure for the feeling of certain emotions and also to perceive certain emotions in other human beings. Remember once again that the amygdala is part of the limbic system. The important point here is that the amygdala seems to modulate our reactions to events that are perceived to be life-threatening. In other words, things like danger and fear stimulate the amygdala. The neocortex is responsible for thinking and reasoning. In summary, the neocortex will interpret information coming from the outside world, and the limbic system produces emotional responses to this information. This is an oversimplification, of course, but the point is that knowing and feeling are things produced in different regions of the brain. We have to understand a little bit how the environment causes emotions in the brain. The sensory information from the outside world, like sight and sound for example, enter the brain through a structure called thalamus, which is a sort of sensory gateway of the brain. The thalamus connects to the neocortex where this information will be interpreted. For example, light enters the eyes and the sensory information travels to the thalamus. From there it goes to the visual cortex where it will be interpreted. This is the pure interpretation of what you are seeing, which is different from how you feel about it. To produce some sort of emotion, this information has to travel from the neocortex to the amygdala and the hippocampus. The hippocampus is responsible for memory, and the amygdala produces the appropriate emotional response to a memory. For example, if you see something you fear, the neocortex interprets the image, associates it with a bad memory in the hippocampus, and the amygdala produces the appropriate emotional response. In summary, the neocortex understands what's going on, the hippocampus remembers stuff for you, and the amygdala is what produces emotions. This is what happens under normal circumstances. The information enters through the thalamus, goes to the neocortex, and comes back to the limbic system. In this paradigm, you are able to use self-control to manage your emotions because your neocortex is turned on, counterbalancing any emotional response that might be too disproportional coming from the limbic system. It's the battle between reason and emotion. However, the brain has a defense mechanism against emergencies. The thalamus also connects directly to the amygdala. That means that depending on the information that arrives at the thalamus, the amygdala will short-circuit the neocortex and produce the fight, flight, or freeze response. That happens when you are in a situation that is too emotionally charged. Your brain detects that you don't have the time to deliberate about the situation and you need to react quickly. So the amygdala hijacks the neocortex by activating the hypothalamic pituitary adrenal axis. And from that point onwards, irrational behavior emerges. This is known as the amygdala hijack because the amygdala hijacks the function of the neocortex as a defense mechanism. This evolved successfully in a time where human beings had to run away from dangerous animals in the wild, but the mechanism still remains intact and it still gets activated if we face extreme situations. Bringing this to the trading context, if you see your account being destroyed by the second because you over-leverage the trade that is going against you, your brain associates this with a bad memory of losing money and everything that goes along with that. And because the situation is too extreme and happening too fast, the amygdala will hijack the neocortex and assume control of the situation. It's important that you understand that this sort of thing is not under your control any more than many of the stuff that happens in your body that you are not aware of. If the danger detection mechanism of the amygdala senses that you are in desperation, there is nothing you can do about it because the rational you in this context is the neocortex, which is being hijacked by the amygdala, which is the irrational you in a way. When the amygdala assumes control, your behavior will be entirely emotional. There is no rational thought, abstraction, or deliberation taking place because the neocortex is shut down. It's not difficult to see that behaving like this will never produce a good outcome in trading. It's impossible to intelligently manage emotions that are too extreme because of the amygdala hijack. The trick is to avoid situations that are too extreme. That's one of the reasons why it's not a good idea to over-leverage your trades with overconfidence. The more leverage you use, the more you run the risk of the amygdala hijack. Another way of looking at this is that the connections from the limbic system to the neocortex are stronger than the connections from the neocortex to the limbic system. In other words, the limbic system, which can be violent and irrational, can easily override the deliberative and thoughtful neocortex. This is the danger of putting yourself in extreme situations not just in trading, but in life in general. Traders like to talk about how important it is to manage emotions, but there are certain emotions that are impossible to manage. The key element in emotional control in trading is not discipline nor willpower. It's how much risk you take. The amygdala can sense how much risk you take, so risk is directly proportional to the probability of an amygdala hijack. Once the amygdala hijack is triggered, the trader hits a point of no return emotionally. This sort of thing can also be exacerbated if your life depends on the outcome of your trades. That is another reason why you cannot rely on trading to pay your bills. This concludes this free course about the dangers of retail scalping. I hope you are able to learn something new and hopefully this information will steer you away from bad behavior. If you are interested in scalping, I suggest you move away from retail scalping and begin to learn about institutional scalping, which is a completely different world. Throughout this course, you learn that retail scalping is fragile and vulnerable to the uncertainty of the markets. However, there is a way to scalp the market that goes in the opposite direction, meaning strategies that gain from the inherent uncertainty of the markets instead of being destroyed by it. That's what institutional trading is all about. In the financial markets, the only certainty is that there is going to be uncertainty. Based on that premise, institutions developed a way of trading in which uncertainty itself generates profit. That paradigm shift makes it possible for traders to make money regardless of market direction and also when bad news hit the market unexpectedly. However, explaining how all of that works is outside the scope of this video. If you want to understand more about that, access my website in the video description and go to the ebooks section, or send me an email with your questions. If you enjoyed the material I produce, please consider clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. Thank you very much for watching, and take care.